Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 130 on September 5th, 2020. I'm your host, Eric. And in this week's show, we will cover the trades from last week on Corbus Pharmaceutical, Freeport McMoRan, and Oracle Corporation. And then we discuss three new trades on Dave & Buster's, Bristol-Myers Squibb, and Coca-Cola. Now, it's always great to hear from listeners. If you have any questions about the trades presented here or about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a short video series to teach you all the basics of option trading that you'll need to know to be able to follow along with me on the show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the equity markets seemed to take a breather this week, posting slight losses. The Dow Jones Industrial Average lost 520 points this week, closing the week at 28,133 points. The S&P 500 index lost 81 points this week, closing on Friday at 3,426 points. So now it's time for the topic of the week. And this week, the topic is all about your decision-making process. More specifically, it's about reconsidering the reasons why you do the things you do. Now, consider for a minute the number of things you do in a given day without much thought, the things that you do automatically. How many times have you driven home without even considering the various decisions and turns and whatnot that you made just out of habit? How about your morning routine? Do you automatically, somewhat like a robot, execute the same task each day, just like a robot? Now, some of you may wonder how this applies to trading. Well, there are likely things that you do out of habit in trading as well, or maybe it's things that seem rational that actually aren't rational when you consider the statistical data behind it. Now, what has me thinking about this is a book I've been listening to. So I've been listening to the audio version of a book called Alpha Brain by Stephen Denier. And he points out a number of errors that are often made in trading that sound good, but in reality just aren't. For instance, he really goes after the notion of trading on house money, kind of like a gambler. Now, this is when you have a trade that has made profit, so you decide to cut the trade in half to recapture your initial investment, and you're going to let the other half of the trade just ride on because, it's house money. You're trading on your winnings. It's been proven that this is actually the wrong thing to do and will likely lead to loss or at least suboptimal trading results. But the reason people do it is they feel like, hey, I've taken my money off the table, and because of that, I'm going to allow the profits of the trade to make more profits. The truth of it is that's a second trade and requires an entirely different set of decisions than you made in that first trade. And that's the reason for the difference in results. By taking half of the money off the table, it's not that you've just recouped your initial capital. It's that you're making another trade decision that needs to be treated and with that much precision and that much analysis, right? So if you, like me, if you want to consider why you do the things you do, like why you make decisions the way you do and how that affects your trading results, and even just consider that maybe some of the things that you've been used to doing and the reasons why you've done it just might not be getting you the trading results and the life that you want, I definitely recommend reading or listening to the book for Alpha Brain. I probably in a given month listen to 2 or 3 books, and oftentimes I will, if I read a book or listen to a book that I really enjoy, I will actually turn around and buy it. So the author gets my money twice, but I'll buy the book just because I want it as part of my library. I have more than 600 books here, the majority of them being about trading, and I turn back to those as a resource from time to time or as often as needed. So that's it for the topic of the week. Let's dive into the trade review for last week's trades. As usual, we'll start off with the covered call. We looked at Corbus Pharmaceutical again, symbol C as in Charlie, R as in Romeo, B as in Bravo, P as in Papa. At the time, the stock was trading for $9.12 a share. I looked at buying that stock and selling the September 10 call at $2.75, hoping for a maximum return of nearly 40% in 3 weeks. Well, Corbus stock rose 13 cents per share this week, ending at $9.25. The call option we sold is up about 25 cents. Now, if you were to close this trade right now, you would actually lock in a loss because of the call option. However, we wouldn't close the trade right now. The stock went in the right direction, and we obviously will make our highest profit if stock closes above $10 per share. Now, some of you may ask, what happens if stock closes at $9.75 or somewhere between what we paid for the stock and our $10 strike? Well, at options expiration, we would still keep the stock that we purchased, and we get to keep the premium that we collected when we sold the option. Then you can decide to sell another call option against the stock in the next month. So we collected $275 for selling this option. That's 30% of the price we paid for the shares of stock. If we were able to sell another option of equal value next month, we would have collected a total of $525 for selling options, and $550 for selling options, and you would still have only paid the $912 for the stock. So as you can see, there are reasons to really like the covered call strategy. I mean, when it works well. The reason I get upset with this strategy is that the stock is unhedged. So the largest losses in this strategy happen when the stock tanks. You're only protected by the amount of money you collect when you sell that call option. So sometimes that's just not enough. Overall, this trade is working though, so no adjustments needed. Our next trade was the credit spread on Freeport McMoRan, symbol F as in Foxtrot, C as in Charlie, X as in X-ray. At the time, the stock was trading for $15.65 per share. I looked at selling the September 15 put spread at 18 cents, which can give us a maximum possible loss of 32 cents per spread. Now, Freeport McMoRan stock gained 37 cents per share, closing the week at $16.02. The out-of-the-money put spread we sold is still out of the money. If you were to buy the spread back right now, based on the posted offer, you would lose 1 penny. However, we know that if stock closes the next couple of weeks above $15.50 per share, we will get to keep the full 18 cents we collected for selling the spread. So this trade is working. Definitely, I would not look to close the trade because it's working, so no adjustments are needed. And then our final trade on the week from last week was a debit spread on Oracle Corporation, symbol O as in Oscar, R as in Romeo, C as in Charlie, L as in Lima. At the time, the stock was trading for $57.88 per share. I looked at buying the September 57 half call spread for 33 cents, which could give us a maximum gain of 17 cents or a 51.5% return in 3 weeks. Well, Oracle stock lost $2.15 this week, closing at $55.73 per share. The in-the-money call spread we bought is now out of the money. So if you cross the bid-ask spread, you could sell this option at a posted price of 7 cents per spread, which would lock in a loss of 26 cents per spread. Now, if you placed a limit order at the midpoint of the spread, you would sell the spread for 19 cents, locking in a 14-cent loss per spread. Now, with 2 weeks left in this spread, for many people, it's worth closing the spread and locking in a loss and just moving on. Now, when I look at the stock chart, and honestly how it's moved over the past few weeks, I am comfortable with the idea of holding the trade and seeing if stock rises again in the next 2 weeks before option expiration for September. Now, I know the risk, and I knew the risk when I entered this position, and I'm willing to leave this one going. Certainly for the next few days and just see how the price plays out. And this is what makes trading part art and not just science. We all manage risk and capital differently. And even as a professional trader, I realized that I manage risk for company money, like for my job, differently than I manage it for my own personal account. And in theory, that's completely irrational. But still, we are emotional beings and we act accordingly even when we think we're being fully rational. And that's what's made behavioral economics, which Richard Thaler, one of the professors from my graduate school, University of Chicago, that's what he earned a Nobel Prize for a few years back. And it's really become much more popular in recent years. So that's another topic for another day. For now, just know that this trade is losing and requires a bit of analysis to decide if you think it's going to regain some of its profit or if it's worth closing and figuring out possibly another trade to recoup the losses from the trade this week. So that's it for the trade review for this week. Let's go ahead and get into the new trades for this upcoming week. And I always love giving new trades for this week. So many shows only give a handful of trades, but they never really talk about the results and they never really discuss how they would make a decision to either alter the trade or close it or what they would do. And I feel like that's really what makes my show, this podcast, different. And I'm so glad that you guys listen to it. I get emails from various listeners every week letting me know that they appreciate that part of the trade, that part of the show specifically. But let's go ahead and get into the new trades this week. Hopefully they'll make me some money and hopefully they'll make you some money as well if you decide to take a look at it and see if it fits your strategy. So we're starting off with the covered call on Dave & Buster's Entertainment, symbol play. So P as in Papa, L as in Lima, A as in Alpha, Y as in Yankee. The stock ended the week at $18.85 per share. I'm looking at buying that stock and selling the September 19 call at $2.10, hoping for a maximum gain of almost 12% in 2 weeks. Now, you enter this trade by buying Dave & Buster's stock for $18.85 per share and selling the September 19 call at $2.10. This trade makes the most money if stock prices finish above $19 per share, and the break-even price on this trade is $16.75. The stock purchase in real terms would require $1,885, and you would collect $210 for selling the call option. Our next trade for this week, new trade for this week, is the credit spread. I'm looking at Bristol-Myers Squibb, symbol BMY, B as in Bravo, M as in Mike, Y as in Yankee. The stock ended the week at $59.95 per share, and I'm looking at selling the September 60-61 call spread at 34 cents, which could give me a maximum possible loss of 64 cents per spread. Now you enter this trade by selling the September 60 call at $1.34 and concurrently buying the September 61 call for $1. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices finish below $60 per share. The break-even price is $60.34 per share, and in real terms, you would receive $34 per spread that you sell and have $64 at risk because this is a $1 call spread. And our final trade on the week is going to be a debit spread on Coca-Cola, symbol KO, K as in Kilo, O as in Oscar. And I love trading on these old school, strong dividend paying stocks. The stock ended the week at $51.04 per share. I'm looking at buying the September 50.5, 51 call spread for 34 cents, hoping for a maximum gain of 16 cents or 47% return on my capital in 2 weeks. Now you enter this trade by buying the September 50.5 call for $1.17 and concurrently selling the September 51 call at 83 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices remain above $51 per share. The break-even price on this trade is $50.84 per share. And in real terms, you will pay $34 to enter this spread, and your maximum gain is $16 per spread. So that's it for the trades this week. Thank you guys for listening once again. Thank you for sharing the show as well. I can tell that it's growing, and that growth is happening because you guys are sharing it with your family and friends. So thank you very much. Keep an eye on these trades. Like I mentioned, there's only 2 weeks left in September expiration. I believe that means September expiration is on Friday, September the 18th. And then we'll definitely be moving into October expiration date trades next week. So that's it. Have a wonderful weekend. Happy Labor Day if you're in the U.S. And as usual, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.